So guys, welcome aboard to the webinar here. Maybe you're new, maybe you're revisiting us for the second or third or fourth time, who knows? We do have a lot of repeat people that come on these webinars. If you're here for the Norada Capital Management webinar, you're in the right place. If you are here for something else, probably not the right spot. So you can always exit. My name is Nate Hall. I work with Marco here at Norada. I work on the Norada real estate side as well as the Norada capital side. Right, there's two main companies here at Norada. One's real estate focused, and the other one is private raise focused, growing companies. So we're going to be talking today about Norada Capital specifically. Now, we a lot of times we like to tie in topics about Norada Capital and what we see other investors doing. Now, a lot of our investors that invest in Norada Capital invest in real estate, right? And we'll talk about how that works here. And so we're going to tie in those investors that invest in real estate and Norada Capital to a subject that's near and dear to both Marco and our hearts, which is the for-profit centers of real estate. So it's unique how you can take capital that you're earning in Norada Capital, put it into real estate, and have it make you major profit centers in rental properties. So a little bit about myself. I've been in this industry for over a decade. I've helped thousands of people buy investment real estate. I've helped hundreds of people raise capital. I help Marco raise capital again at the Norada Capital here as well. So I work in this world. This is what we do. And I'll let Marco take, he could spend an hour talking about all his accomplishments, but we'll try to narrow it down into maybe 60 seconds here. So Marco, for those who don't know you on here, if you can give a brief introduction, that would be ideal.
Yeah, sure. So I am, as Nate said, I'm Marco Santarelli. I'm the founder and CEO of Norada Real Estate Investments and Norada Capital, which is our private equity firm, which is an investment fund for you and gives you the opportunity to invest and earn 12 or 15% per year. So I have been involved in real estate since I was 18 years old. I've always been interested in business, entrepreneurship, making money, essentially. I look at money as a game that I take seriously, but it's something that I always wanted to be a student of and continue to be a student of. And so for me, building, growing, and scaling businesses, investing in real estate, and other asset classes is just something I've always been interested in. So I've been involved in everything from cannabis to crypto, Broadway productions, what else? Real estate, obviously, oil and gas. I've kind of touched it all. Obviously, I have my favorites, but so what we're building here today, this year, last year, next year is pretty exciting. And Nate, amongst others on my team, are going along for the journey and the ride, and we're impacting a lot of people, literally thousands of people. Not just that, we're also impacting people in other countries through nonprofit organizations to help provide them clean water, food every day, education, even entrepreneurship, so we can help them create sustainable businesses, solopreneurs, and sustainable communities. So it's pretty far reaching.
Yeah.
That's a quick summary for me. So Nate, back to you.
Yeah, love it. Well, and so obviously there's business endeavors that you're going after right now, Marco, to grow and expand your portfolio. But I think beyond that is unique at what you just said. Beyond that, there's opportunities to give back and impact people around the world. I know one of your partners, Eddie, is huge on that too. So, and we'll talk about what backs the fund here, guys, in just a second. So typically the kind of organization of events here is we talk about what a promissory note is. It's a very basic instrument. We talk about what is in the actual fund, like what companies back your investment in Norada Capital. And then we will dive into our topic today, which is for-profit centers. So we'll get through the topic, and then usually towards the end, we'll do a Q&A, right? So there, again, to circle back to what Marco said earlier on the call, there is a Q&A box that you can ask your questions. And we actually already have, a question coming in. We will usually get to questions at the end there, Mike. So we've notated your question there, and we'll talk about that. So use that Q&A box, guys. As questions come in, we'll get to as many as we can. Sometimes there's enough where we can't get through all the questions, and you can easily email us and contact us directly from the Norada Capital website if we don't get to your question. So with that said, Marco, we always start with what a promissory note is, the basics of it, how they're used on a daily basis to raise capital. I have the note pulled up as well, like the actual offering pulled up, so I'm happy to
Yep.
share my screen like usual. But what you want to start there in terms of your description of what the promissory note entails?
Yeah, let me just answer that in 30 to 60 seconds
Yep.
so that we just do the short version of it so we can dive into our topic for the day, which is the for-profit centers of real estate, which I
Yep.
would argue is five, but you and I can discuss that and talk about it. And it's something we could talk about for, literally 2, 3 hours, just because there's so many roads to go down with real estate. But let's just touch on the promissory note thing so everybody's on the same page with that, because it is the instrument or the vehicle that we use in raising capital through Norada Capital, but it's something that's used all the time. So a promissory note is nothing more than a loan agreement. It involves two parties, and that agreement just lays out the terms, the start date, the end date, the interest being paid,
Yep.
and when it's being paid, and then when the note matures and how that payoff happens. Is it amortized? Is it a balloon payment? Is it, however that unfolds. But if you've ever signed a car loan, signature loan, bike loans, a student loan, most any loan is on a document called a note or a promissory note. It might say loan agreement on it. If it's a mortgage loan, it might say, loan agreement or mortgage loan agreement or something to that effect. But ultimately, it's the same thing. It's just the size of it changes. But that's it. So promissory note is nothing more than a loan agreement between two parties, a borrower and the lender. Just to take that one quick step further, Norada Capital raises capital not through issuing equity, but through issuing debt.
Right.
So we raise capital using the promissory note, and we pay a healthy 12% per year or a healthy 15% per year paid monthly. It's just an automatic deposit through Wells Fargo into your bank account each and every month. And that bank account, as long as it's a US based bank account, um, can be a self-directed retirement account like an IRA, a 401k, a Roth account. It could be your own personal checking account, it could be a business checking account, it could even be a savings account. It doesn't really matter as long as it's a US based account. Then we can get it authenticated with Wells Fargo and then just set you up on automatic monthly distributions, monthly payments until your note matures. When your note matures, your principal is repaid. And at that point, you just decide, what you want to invest in at that point in
Yeah.
time, regardless of whether it's with us or elsewhere. So
Yeah.
that's a promissory note.
Yeah, I love it. And this is designed for cash flow, guys. A lot of you guys on here might be real estate investors. We have a lot of real estate investors that cross over to this space. So this type of investment is designed for income. This is an income approach. This isn't a long-term appreciation play or tax benefit play. It's a loan agreement between two parties. Let's say I loan Marco, Norada Capital Management, $100,000. That's going to get me 15% annually, and that's going to pay me monthly, right? So those distributions come back to me monthly. And there's three tiers. I'm happy to share my screen here for a second so we can walk through those tiers. Marco, I just need you to give me access to
Oh,
share my screen.
I
And
thought you had access. All
I
right.
usually do, but it looks like there was some setting changed.
All
Some
right.
settings changed.
All right. I made you a co-host. You
Thank you.
should be good.
So this is the note, guys. Pretty straightforward, right? These are the terms. So as long as you're an accredited investor, we're what's called a 506C Reg D offering. So we work with accredited investors. Get with us or your CPA if you have any more questions on how to get that done. But you can choose your term between 3 and 7 years. The interest rate is 12 or 15% paid out to you depending on the amount invested. So 50K is our base minimum, 3-year term is our minimum. So 50K, 3 years is our minimum. That pays you 12%. Anything over 100K pays you 15% annually. Anything over 200K pays you 15%. And there's also a back end payout, so a back end bonus on anything 200K or more. So easy explanation is you invest $200,000 for 3 years minimum. That's 5%, that's $10,000. So we'll pay you 36 payments over those 3 years, and we'll give you a 10K bonus at the end of that 3-year term. And that's the basis, right? It's a very straightforward loan agreement. We've just chosen to Marco and his ownership group has just chosen what the minimum was, what those terms are, and what they've decided to pay. I will put this investor slide deck in the chat box so everybody can access this. It should be something that you've seen already. If you are on this webinar, we have definitely sent you this prior. It may have gone to your spam folder, but again, I'll get you guys access to it here in a second. So that's the basic walkthrough of the note. So moving forward, before we dive into for-profit centers, Mark, if we can take 3 or 4 minutes and just talk about what backs the investment, what backs the note. So if I'm investing $100,000 with Norada Capital, what's protecting my note? What are the assets under management that back that note?
Yeah, so the quicker answer to that question for the sake of time is Norada Capital has five main categories, but focuses on two specifically in terms of the assets that we invest in. When I say assets, they're typically businesses or business ventures.
Right.
The first main one or big one is e-commerce, and then the second one is what I refer to as masterminds or educational masterminds. The e-commerce businesses, for those of you not aware of what we've done over the last 3-4 years, is we've made acquisitions into name brand assets that were once near billion-dollar or billion-dollar businesses that filed for bankruptcy. And then we went in and made an acquisition to acquire their intellectual property so we can continue running that business or building that business online instead of having a whole bunch of stores, brick and mortar stores with staff and inventory and whatever else, the leases and the heavy debt. So the first venture was Dress Barn, which was a nationwide retailer of women's apparel, which is now no longer just women's apparel. We've expanded that footprint as far as the type of product. But Dress Barn was our first acquisition. And then that went so well, that process of going through that Chapter 7 bankruptcy acquisition, that we went after Pier 1 Imports, which is a brand that's known worldwide, but has obviously a huge footprint and impression in the US. So the brand equity is very, very high. Now, there are no physical stores anymore, but we do own that business and run that business entirely online. And our plan is just to continue and grow and scale that. So we're in the growth mode right now of
Right.
increasing our daily, weekly, monthly revenues on that site. So Dress Barn and Pier 1, Linens and Things, Steinmart, Model Sporting Goods, the Franklin Mint, maybe not classified as much as an e-commerce based brand, but bodybuilding.com is a major international brand that has 4.3 million visitors per month. And there's a lot of possibility there. So we're going to be monetizing that traffic, this year, more so than what it has been in the past. So those businesses form the e-commerce based component of Norada Capital. The other major component, which collectively makes up about 90% of our business ventures, our assets under management, if you will, business assets under management, is what I call educational masterminds. And so there are three main businesses that fall under that category. And these are very exciting and the ones that are growing very rapidly and making a huge splash or footprint across the country right now on a monthly basis. And it's our Aspire event, Aspire Tour. If you want to learn more about that, you can go to the
Yeah.
website, which is aspiretour.com. And then that event, that major monthly event, which has anywhere from 2,000 to 4,000 plus people each month at each of these events, leads people to our master classes and then ultimately our mastermind. So we have our Money Is mastermind, and then we have our Level Up Real Estate mastermind as well, which is for those people who want to stay hyper focused on all the ways to make money with real estate. So so those are the two masterminds that we provide constant education, daily, weekly, monthly. We have live events every quarter in different parts of the country, either in Florida or I guess Salt Lake is the next one coming up, Salt Lake City. So that mastermind ecosystem makes up about 55% of our allocations, our assets under management. And those two together make up about 90% of Norada Capital's balance sheet. The rest of it is made up primarily of Broadway musicals, productions on theatrical productions, most of which are Broadway based. There's only two that are not right now. And that would be The Devil Wears Prada, which is opening up in London, this summer, and then one called Pleasant Grove, which is based out of Utah, that is headed for Broadway, but it's not there at this point in time. So the Broadway productions is just something that it's fun, it's exciting, it's kind
Yeah.
of like a more of a passion project and a sizzle. It can be very lucrative. It is a good money maker when you have good productions, bigger productions, like when you hit Hamilton or Wicked or a Lion King or anything of that level. But that's usually about 1 in 10 productions that do that well, that run for that long. But those three make up almost the entire fund. Um, Nate, is that enough, or do I have to drill
Yeah,
down?
I think that gives a good foundation. Again, I put the investor slide deck in the chat box, so you guys can download that slide deck and you can see the rest of the holdings, right? You'll see all the mastermind companies, you'll see the e-commerce businesses that we own, and you'll see the other smaller things like land development, Airbnbs, things like that. So um, that's all there for you guys. I also put in some examples, like if you go to peer1.com, it's an example of e-commerce business. They're real businesses. You can buy product right now. I also put the Aspire tour homepage, so you guys can check out, the next cities we're coming to if you do want to attend one of those events. Um, so let's take a turn here, and we'll move into kind of the topic for today, which is what I see a lot of investors do with the income they're creating from their notes, right? If you invest $100,000 or $200,000 at 15% per year, it's a good cash flow coming into you. What a lot of investors do, and a lot of our clients are real estate based clients, so they'll take that 15% return and they'll invest it into a piece of real estate. Okay. And we have a brokerage too that helps investors buy, 6 to 800 doors a year, that's been around for 2 decades, right? It's another Norada brand brokerage. So I think what's unique about the investors that utilize note income, whether it's inside the retirement account or outside their retirement account, and then they take that income and they buy investment real estate with it, they are drastically increasing their IRR on the note income, right? You're already making 15% on your investment if you're doing 100K plus. If you take that at the end of every year, or halfway through the year, and you buy a piece of real estate, now you're increasing your return, right? Drastically. So what we're going to do is walk through some profit centers here. I know this is a very good topic for Marco, because Marco loves numbers. He likes the analysis side of real estate for sure. So Marco, let's just say, for example, I invest $200,000 for a 3-year note. That's 30K per year, right? I can take that first year's earnings, that 30K, and I can buy an investment property in Alabama, in Indiana, right? In Kansas City for 20% down. And that income I used from the note income to buy that piece of real estate is making me multiple profit centers. So let's walk through, I guess, profit center number one, which I think a lot of people get caught up in, which is not necessarily the most important one, but cash flow, right? So how would you define cash flow, the importance of cash flow as a profit center?
Yeah, so with income producing real estate, and we're talking about residential real estate here. That's
Correct.
our main
Single
focus.
family homes.
Yeah, typically single family homes. It could be duplexes, triplexes, and
Yeah.
fourplexes, but nothing more than 4 units per property, because the financing changes
Yeah.
on real estate investment when you are over 4 units on one particular property. But one of the profit centers, the first profit center would be the cash flow, the income stream that can be generated from a piece of property. And for many investors, this is what they invest for. Maybe not necessarily right away. They do have positive cash flow the day, or the day they buy it, or the first year that they have that property. But it's something that they build over the years and increase as rents go up. And in time, ultimately, if they choose to pay off the mortgage loan, that now becomes cash flow as well. It's spendable cash that goes straight to your pocket. So for many people, it's one of the most attractive features
Right.
about residential real estate, is just that steady rental income. Now, when you build a real estate portfolio and you have 2, 3, 5, 10 properties that are generating, let's just call it 3, 4, $500 a month each, all of a sudden it becomes substantial. And that is enough income for many people to become financially independent or
Mhm.
financially free, because if it exceeds your monthly, what I call your monthly nut, but basically your monthly expenses, and then you have leftover, like a disposable cash, investable cash, Great. Now you're financially free. You don't have to be, tied to a W-2 job or a 1099 or anything like that. You can work,
Right.
because you want to, not because you have to. So cash flow is definitely that first pillar. And as you build your real estate portfolio, you'll see that grow and it becomes pretty substantial. Nate, anything to add to that? Add to
So let's
that?
let's just pause there for a second and say, okay, I've invested 100,000, $200,000 in run of capital. I've made my income. I'm going to take that income and I'm going to buy a piece of real estate. Right now in today's market, you're seeing anywhere. I mean, interest rates are higher, right? So let's say our cash flow or our cash on cash return is 7%, right? Kind of like an index fund. So let's keep it on the conservative side. I mean, I still see 8, 9, 10%. But let's say our cash on cash return from our cash flow is 7%. So all you guys listening to this webinar, grab a pen, pull up your Word document on your computer, whatever, notate profit center number one as cash flow or cash on cash return, and write down 7%. And I'll do it on my end too. Right, we're going to keep track of this. So profit center number one is 7%. And we'll come back to this. So we're doing this for a reason. All right. So 7%, keep it conservative. Profit center number two, right? Typically, what I like to call it is equity accrual or principal pay down, however you want to factor it in. Really powerful, right? Principal pay down comes into effect when you're leveraging, right? So you have a loan, your tenant is paying down your mortgage for you, right? Which over time gives you the ability to borrow more money from that property. So, Marco, how would you do you want to elaborate on increased equity or principal pay down, that concept as a profit center?
Yeah, I look at equity growth in two ways. One is the principal pay down, which is referred to as the amortization of the loan. So if you
Mhm.
have a mortgage loan on a property, as that gets paid down month after month after month by your tenant, by the way, not necessarily by you, because your tenant's paying rent, you're using that income or that revenue as rent to pay the debt service on the mortgage loan. So in each and every month, that principal gets reduced a little bit more, a little bit more, a little bit more. But as the months go by and as the years go by, it accelerates. You're actually paying down more and more principal each and every month, and less interest. So it actually tends to accelerate. That means your equity is continuing to grow at
Yep.
an accelerated rate each and every month and each and every year. So that's one form of equity growth. The other form of equity growth is what a lot of investors focus on when it comes to real estate, and that is appreciation. Because over time, residential properties have, at least historically speaking, appreciated in value. So this means that the value of the property, um, let's just call it the price. The price of that property increases each and every year over time, and that just leads to increased equity. Therefore, your net worth goes up, and that equity is usable. You can tap into it if you want to down the road.
Mhm.
But the potential for capital appreciation can significantly boost the returns on your investment. And I can give an example here in a moment to kind of illustrate the different rates of return in residential real estate. It's not just the cash flow, which you typically measure as cash on cash return. There's more to it than just that. So so when you talk about equity, Nate, there's the appreciation, which is the increase in price,
Mhm.
and then there's the equity that increases from the loan being paid down, the
Yep.
amortization of that loan. So those are the two components. Anything to
And
add to that?
usually I break that into two. So what you just hit on is profit center number two and three to me. So profit center number two is the equity accrual. That's from the tenant paying down the mortgage, which gives you access to more equity in the property. And then number three, which you hit on, can be property appreciation, which is like a cherry on top, right?
Yeah.
So you might be in a very appreciation based market or
Mhm.
like a slower appreciation linear market. But again, I think you said you're going to pull up an example, Marco. But guys, for our example, for what I'm talking about here, number two, let's call it increased equity accrual annually. Let's just say that that's 3%, right? And it might be less, might be more depending on the loan, the amount, the interest rate, but we'll call it 3%. And then appreciation, let's keep it super conservative, right? Let's keep appreciation at 5%. So grab your pen, grab your computer. Profit center number one, we had 7% for a cash on cash return. Profit center number two, equity accrual, we had 3%, and we've got 5% for profit center number three, which is appreciation, right? And what we're doing is we're adding up the IRR, the actual return on our down payment, right? We took that money that we earned from our note investment. We're buying a piece of real estate, and we're going to add up what our actual yearly IRR, what an estimated IRR would be on the use of that note income for a down payment. All right, so profit center number four, we haven't got into yet. If you have some guesses there, on this call, it's taxes or depreciation of the asset's a major one, right? So tax benefits. One of the biggest ones is the depreciation of the asset. So Marco, do you want to talk to depreciation?
Sure. Yeah. So you made a good point, Nate. There are kind of two different tax benefits with real estate. A lot of people just refer to it as one, but if you want to call it a tax benefit, the first one would be just all the expenses, any repairs and maintenance and capital expenditures that are spent on a
Yep.
property, either lowers the revenue, like the income. Um, um, well, let's put it this way. Expenses are essentially a tax write-off. So you are deducting maintenance and repair expenses as deductions from the income on your property. Those are going to be necessary expenses anyway, but the fact that you can write it off as a business expense is is a tax benefit. But the big one is really what you're talking about, and that is the depreciation. So
Yep.
the IRS allows you to take residential real estate, any residential real estate, and take the improvements meaning everything but the land, everything that's built and stacked on top of the land, and depreciate that over 27.5 years. I don't know why it's 27.5. It's a strange number, but it's 27.5 years. So whatever that is, you divide whatever the value is of the improvements, the building, all that stuff. You can divide it by 27.5, and that number is what you can deduct each and every year as a deduction on your taxes. It's just known as depreciation because the IRS just assumes that this asset will wear out. It'll depreciate over time and things will need to be replaced. So they're allowing you to actually take that as a tax write-off.
Yeah.
Now that is deducted from your passive income, which is great because it can be applied to any and all forms of passive income. But if you're one of those individuals out there that can claim to be a professional real estate investor because you've met, various criteria, one being you spend 750 hours per year or more in real estate, whether it's selling real estate, managing real estate, just in the real estate space, real estate industry, as an investor or an agent or whatever it may be. But if you can claim that you have the professional real estate status, then that depreciation can be applied to active income, not just your passive income. So it applies to any income that you have, which makes it very, very interesting and powerful. So, so the tax benefits for depreciation is that you can just take whatever that property is worth, less the land, and divide that by 27 and a half and deduct that each and every year for 27 and a half years against your passive income and maybe even your active income.
Yep. Love it. Love it. And so just the basic calculation on the 27 and a half year, uh, average wise, I mean, that's going to depend on the value of the home. Again, Marco said less the land value, right? Usually the building value holds a lot more value, usually around 80% of the total value. But let's just say like every year you appreciate the asset and that adds another, 5% to your IRR, right? Your down payment. So, and Marco, did you have an example you wanted to pull up of this before I add this up, or did you?
Yeah, actually,
I'm not sure if you'd pull something up on your screen there, but you'd mentioned pulling up some numbers. So,
yeah, I mean, I can just give you I can just blurt out some numbers based on the numbers you were using, actually.
yeah,
So,
we're at
so
about 20% right now. So,
okay, so let me break it down this way. Let's just
yeah,
say we'll take an example here. Let's just say you're investing in a property. Its purchase price is $200,000.
yeah,
You're going to put the typical 20% down. 20% of a $200,000 property is $40,000. So you're investing $40,000 to acquire buy, own, control, and benefit from 100% of this property, even though you're putting 20% down, you get 100% of the benefits and 100% of the ownership and 100% of everything. So you put $40,000 down, and using your 7% cap rate that you mentioned before, or your 7%, we'll just call it the cap rate. Um, that that means that you would have a cash flow on that property of about $230 per month. It can be more. It is often more than that, but we'll just use this as an example. I think it's a little bit on the conservative side because, of course, you want to budget for maintenance and repairs, and you want to budget for vacancy, which will happen from time to time. But all in all, it'll probably run you an average of $230 a month net spendable cash flow. That's net cash flow. If you're generating 230 a month, that's almost $2,800 a year in cash flow on that property, which gives you that 7% number you were talking about, Nate, that 7% cash on cash return. So you're making 7% per year cash on cash. It's basically 7% on the 40,000 you invested. So that's profit center number one. Now
And a
we talk,
reminder, Marco, just to we're assuming we're using cash flow from our note investment to buy this property, right? The whole point of tying this in is to say, hey, here's what a lot of investors use the cash flow from the note investment for. So we've already made 15% from the note income. Now we're using that to buy a piece of real estate.
yeah, yeah.
Yeah.
And so now we were talking about equity growth, equity gains.
Yeah.
So there's essentially two types, as I talked about before. There's the amortization of the note, which gives you an equity gain and more each and every month because the amortization accelerates. But in year number one, in the first year, that particular mortgage, and I took 7% as the mortgage rate on that. I mean,
Yeah.
obviously I can change this to make it 5%, but I'm being, again, pretty conservative with the 7%. But 7% interest would give you an equity gain in the first year, which is the smallest amount of equity gain over the course of a 30-year mortgage. It would be a little over $1,600 for that year. It doesn't sound like much, but 1,600 divided into your down payment of
Yeah. We'll do it
40,000.
right now.
Well, it's 4.1%.
Yeah. There
So
you go.
you've got a 4.1% gain. Now,
Yeah.
this is an unrealized gain. It's not spendable. It doesn't go into your pocket, but it's still a 4.1% gain
That's right.
on that $40,000 down payment. So you're making 4% in equity returns. So you've got the cash flow, and that's a form of return. You've got equity by the amortization of the note, which is 4.1%. But now there's another form of equity that you're gaining each and every year, which is the appreciation. Now we're making an assumption here that it's 5%. That's the number you used. I like to use anything from 4 to 5 to 6%. We'll call it
Yeah.
5. 5 is reasonable. 4 is more conservative. But at 5% per year, on average, that would be a rate of appreciation of $10,000. It's 5% on a $200,000 property is $10,000. So now that property is worth $210,000 at the end of the year. Doesn't sound like much. And again, it could be a lot more than that. But again, being conservative. But again, think about it this way. If you have a $10,000 gain at the end of that first year on your property, that $10,000 divided back into the down payment of 40,000 is a
Huge.
25% return on your down payment. Again, in the form of equity, it's an unrealized gain, but it's
Right.
still 10,000 over that 40,000. So now you have a 25% return. So in terms of equity, you now have a 29.1% return on your investment in that first year. And that accelerates. That actually, increases as the years go by. But you have a 29.1% return in the form of equity on that investment, plus the 7% cash on cash return that you had as a realized gain, spendable cash on that first year with that property. So all in all, if you add them all up, it's a little over $14,000, which is a 36%
Yeah.
overall ROI, return on your investment. Is about a 36. Well, no, it's not about. It actually adds up to 36% exactly.
Yeah.
So year one, 36% return in terms of realized and unrealized gains. And then that just gets a little bit better as time goes on, because you're going to amortize that loan. Your rents will increase over time. And I don't have a crystal ball as far as the appreciation, but you can always assume that historically speaking, over the long term, the average appreciation rate will range from 4 to 7%. And over the long term, it actually has to do that because of inflation, just the monetary impact um, uh, of just our debt-based economic system. It's just we're going to continue to print money, and we have to just keep putting currency into our economic system, and that creates a form of inflation, monetary inflation. So you're going to benefit or gain from that. So just keep that in mind as well. Real estate is naturally a hedge against inflation. The land
Hmm.
is limited in supply. It goes up over time, price wise. And the same thing with the real estate itself. Real estate is nothing more than sticks, bricks, copper, and concrete. And those are all commodities, and those will go up over time because of inflation as well. So real estate, by its very nature, is a good form of inflation protection. It's a
Yeah.
natural hedge against inflation. So those are the main profit centers. Nate, you want to add anything to that, or?
I think you nailed it. I think in my calculation was a little bit less than yours because your appreciation certainly has a bigger impact than what mine did. But yeah, I had 20+%. We were at 36. I mean, regardless, that's a really strong IRR, right? When you're talking about the use of, capital to buy a piece of investment real estate. So you nailed it. I think it's, a great place to at least stop on the, unless you want to add I'm not sure if you added your fifth one yet. So
No, but a quick comment. If you
yeah,
want to take that 20% return on the on the appreciation, that's really just a 4% rate of appreciation per
right,
year.
right.
If you use 4% as the rate of as the rate of appreciation, that will give you a 20% return
Yeah,
um, on your initial down payment of $40,000.
yeah,
But even with that, you add your cash on cash return to the equity growth, plus the appreciation return of 20%. All three of those combined is still a total return on investment of 31% after
yeah,
that first year, which is a very attractive number. It's very healthy.
yeah. Love that. And what I will say as well, since we're continuously tying this back into note investing, is some people use note income for increasing their profit centers and buying investment real estate. Other investors I work with utilize note income to uh, pay down their debt on some of their investment properties, right? I call it a loan acceleration model, where let's say you have $20,000 to go on a property that you own, to get to own it outright. You might use that income to pay down that property, and you're still increasing your ability to cash flow quicker from that property that you might own. So there's multiple ways to use note income. I think we've kind of done a good job here of going over the major profit centers of the real estate piece. We can certainly slide into some questions here if you want to, Marco. Is there anything else to add on your end?
Well, just that fifth profit center, if you will.
Sure.
Yeah, it's what I would refer to as leverage. The fact is that
Yeah.
real estate allows you the opportunity to leverage your investment capital as much as 5 to 1. And so it's not necessarily a profit center directly, but indirectly it is, because it allows you to magnify your returns rather than buying a piece of real estate or investment property with all cash,
Hmm.
100% of in cash. You can put 20% down or 25% down and borrow the rest of it. So you're leveraging your investment capital 4 to 1 or 5 to 1. And that just provides a lot of power, because you can spread your investment capital across more than one property, have a larger portfolio faster, sooner, and that just means that you control a larger asset, a larger portfolio with a relatively small amount of your own money. And then, as those properties appreciate in value, the return on your invested capital can be significantly increased or amplified. So that's just a beautiful thing about real estate. And very few asset classes allow you to do that. You really can't do that with very, very many others. It's the most real estate is the most tax favored asset class. Oil and gas is up there too, but real estate is definitely
Yeah.
very much tax favored. And lenders love it. Lenders love to lend against income producing real estate. They just want to lend on real estate. That's where they make their money. The interest on the mortgage loan that they give to you, But they like it because the real estate provides collateral that makes them feel safe. Um, and that's why, mortgage loans are pretty abundant. Anyway,
No doubt.
so leverage.
Yeah, love it. So leverage is that fifth profit center, guys.
Yep.
Um, all right here. So let's go into some Q&A.
Okay.
Just a couple of questions so far on the fund, really. So Michael asked, the returns you're noting are 10 to 15% per year. Are these the average, ideal, or max numbers? What are the possibilities, likelihood of capital loss? So there's two questions there. There's 10 to 15% returns per year. Are those the max numbers or ideal numbers? Those are fixed numbers, actually 12 to 15%. And then obviously it's a great question in terms of risk, right? So do you want to talk to those two questions, Marco?
Yeah. So it's not the average, it's not the ideal, and it's not the max. It's the exact.
Yeah,
So,
yeah,
and it's not 10, it's actually 12. So if you invest in the Rata Capital and you can choose your term, 3, 4, 5, 6, or 7 years. Uh, but the rate of return, the interest rate is based on the principal invested. So if you invest anything from 50,000 up to, but not including 100,000, it's 12% per year, fixed rate of return. The interest is paid monthly, but it's 12% per year. If you're investing at 100,000 or more, regardless of the amount, it's 15% per year, 15% per year paid monthly. Again, it's just a direct deposit through Wells Fargo Direct Pay right into your account each and every month during the first week of the month. So it's just set up on a reoccurring automatic schedule. But yeah, we get asked this question a lot. If people wonder, is it variable? Is it fixed? No, it's a fixed rate of return. Um, and then the second question, what are the possibilities or likelihood of loss? We get this question fairly frequently on the webinars. Um, for me, the biggest risk factor for me and my concern is things that I refer to as black swan events, just the unknown unknowns. Like if there was another COVID event or a September 11th event or a regional war, hot war, world war, or major economic disruption, like some sort of economic catastrophe or collapse that would set us back for a year or two. Now, short of a nuclear war, almost all these scenarios are recoverable. We've always come out of recessions, depressions, black swan events, whether it's September 11th or COVID or what name it, whatever it is, whether it's 6 months, 12 months, or 18 months down the road, we always come out of it and often better and stronger. So those are the things that concern me, not
yeah,
necessarily on a daily basis, but those are the things that I think about when I think about risk factors, because those are uncontrollable. Most other risk factors are controllable. So um, so the probability, I mean, I'd never say zero, and I would never say anything has zero risk, but the probability of those types of factors impacting us is small. So hopefully that answers Michael's question.
yeah. And then for the follow-up there, can the promise or not be done in a nonprofit? I'm not sure what you were asking there, Michael. If
I'll
you're
take a
asking if
stab
we
at that.
can, what's
I,
that?
I can take a stab at that.
Yeah, go ahead.
Can you use a nonprofit if you are allowed to invest using funds from your nonprofit organization, then you can. Again, as long as it's an account in the US, like a US bank account, US institution, then we can set you up on direct pay and we can send your interest payments there.
Yeah,
So the short answer is likely yes. So
perfect. Um, Frank asked, yeah, I'll type that in, Marco.
okay. What was the next question?
Um, Someone's just asking for contact info.
Oh,
Yeah,
okay, well then I'll just grab another question here.
yeah.
I'll just go down the list. Sonia, where'd it go? Hi, Marco. Are you looking to buy any distressed multifamily assets for Norada Capital's portfolio? No, we don't invest. We don't invest heavily in real estate. The only real estate exposure we have with Norada Capital is a land development, land banking company where we just build we create buildable lots for nationwide home builders. It's a very small percentage of the fund,
Yeah.
but that business does do a fair amount of volume. But we're not looking for distressed assets of any kind. So, but thanks for the offer.
Tom
Uh,
asked about an emergency, if he
yeah.
needs his capital. I know, Marco, typically that's case by case basis for you. There's nothing in the contract. There's no early withdrawal penalty, but there's also nothing in the contract that says you can early withdraw. So is that fair to say, be a case by case, Mark, case by
Yeah,
case?
it's definitely case by case. And we've had some investors that have had, emergencies of some kind, whether it's a family emergency or a medical emergency, something that,
Yeah,
painted them into a corner and they really didn't have, anywhere to turn.
yeah,
So we've made a few exceptions over the years. Just talk to us if that's the case. But by default, it's the notes are locked in for that term,
yeah.
whether it's a 3-year term or whatever you choose. So they are generally not liquid that way.
Perfect.
Yep, next one.
Yep.
Well,
Gerard, you mentioned you issue monthly deposits via ACH. What if you have your note in IRA and the custodian does not offer ACH? Maybe find a custodian that does offer it. Yeah, there's not a whole lot we can do there. Unless
I think
Marco,
I think in the last 4 years, Nate, there was only one custodian
it doesn't offer it.
that
Yeah,
couldn't accept ACH payment. They could accept wires or checks, but not ACH to pay payments. I'm not saying that they don't exist. It's just I only came across one in the last 4 years that would not or could not take ACH payments. Gerard, I would just double check with them to make sure that that's actually what they're referring to as direct deposit, also known as ACH. If they can't, uh, I guess the next best choice would be to find a custodian that can, and it's just a
right.
simple rollover. Shouldn't be any cost to you. It might take a week or so for them to do the rollover to a new account. What I don't know is if we can set you up on, I mean, actually, worst case scenario is we can set you up on something called bill pay, which just means that we would end up sending them a check every month or every quarter through another Wells Fargo service where it's an automated check. So that is also doable, not our preferred method, but it's
Yeah,
doable. So just get in touch with Nate or Kathy or whoever it is you're working with here.
yeah. Rich, to your point on equity trusts, yes, we have hundreds of clients that have notes with us through equity trusts. So yes, we do work with them. And you guys bring up some good questions there. We do work with a lot of self-directed IRAs and solo 401k investors. So this is a really good investment for creating an income stream inside of a self-directed IRA. If you have a previous employer 401k that's underperforming that you want to roll over, or you have a current IRA that you just don't like the performance on, that you want to roll over to a self-directed IRA, you can invest in notes with Neurotic Capital. So good question there, Rich. Thanks, Kumar. Appreciate it. Thanks for joining us. Kumar says, great presentation. Enjoyed it. Your comments on Black Swan events. Do international events affect Neurotic significantly? The happenings in the Middle East, for example. Second, what sets Neurotic apart from other firms like Phoenix Capital, etc.? I have my answer to that, Marco. I know that the interest rate that you choose and Eddie and Andrew and your ownership group choose to use is not predicated upon anything that the Fed's doing, anything that's going on in the world, the LIBOR rate, the prime rate, right? It's a choice that you guys choose to pay. Now, sure, if there's a war that comes to our doorstep or something like that, like a hot war, or if there's something that massively impacts the profitability or the revenues of companies, sure, that can affect your promissory note. That's just part of investing, right? If you have money in the stock market and something like that happens, that can affect your stock portfolio. To be honest, what sets us apart from other firms, I mean, there's a lot of good ones out there. Our interest rate, I think, sets us apart, but also what backs your investment, right? We are a portfolio, we're a fund that's backed by a portfolio of successful companies. A lot of times notes are backed by one endeavor. It might be one real estate project or one, one business raising venture capital that has no track record, right? We have a track record with all the companies that are underneath Norada Capital. So that would be my response to that. And Marco, maybe you have something else you want to add.
Yeah, the short answer would be generally no. It really comes down to whatever that event is, that black swan event that you're referring to. Um, I'll give you an example that can be something that would have an impact and has had in the past, and that is a disruption in the supply chain. If a lot of the products that, for example, what we sell on Pier 1 and Dress Barn and whatnot, come from international countries, especially overseas, whether it be, China, the Philippines, Thailand, whatnot, and
Yeah,
there's a disruption in supply chain, just like what happened during COVID, then yes, it definitely would have an impact, short term, but an impact nonetheless. So that could slow down sales, have an impact on revenue, whatever else, until that clears out. Are we seeing an impact with anything right now? No. Um, but could it happen? It's always possible. And then, your comment about, other companies like Phoenix Capital and not, they're doing, I think, 9 to 12% notes. I don't know a lot about them. When I did look into them, they weren't as diversified. They didn't have a portfolio that was as broad as what we have. Not that ours is very wide. It's fairly specific and niche, but you just have to do your own due diligence and research. You're just gonna have to compare one option to another and see what makes the most sense for you. I personally started issuing promissory notes as far back as 2012, on and off, not consistently, and it was always project specific. And those projects always came to completion, and if they didn't, investors got their principal back. So there's never been a default on a note. Anyway,
good
good
question,
question.
Kumar. Thank you.
Yeah, yeah.
Um, Ray asks, is Norada a potential purchaser or seller of mortgage notes? Great question. We are not at the moment. So that's pretty straightforward answer.
Michael, I like the way you think. I've been asked this a few times. Okay, edge case question. Could I set up a reinvestment on the monthly payments? We're not set up to do that where you take your interest
Yeah,
and reinvest it to compound it. We just don't have this infrastructure or the system or the financial tools to do that. So no, I mean, it's a great thought, but no, we're not set up to do that. But you can reinvest, you can add to your note. I think the minimum add-on is 25,000.
correct.
So you can just add on anytime you want, in blocks of $25,000. So you
Yeah,
can
great
do that.
question.
Yeah.
Tom asked, do you have any qualified 1031 options? Unfortunately, that'd be great. Unfortunately, we cannot do a 1031 exchange into promissory notes. Now, if you have a property you're looking at 1031, Tom, and you want to work on the real estate side, we're happy to have that conversation. We have a brokerage. I'm working with a client right now that's doing a 1031 exchange in Alabama. So um, you can take that offline. You can connect with me through Norada Capital, or you go through Norada Real Estate as well. All right, who else here? Let's see. Jonathan Richards, what new businesses are you looking to invest in? Great question, John. I know Marco can speak more to this. You guys are pretty set on what's in the portfolio right now, but is there anything new on the horizon?
Not with this fund, with our main fund, Norada Capital or Norada Capital Management. There is nothing that we're looking for. We're hyper focused on the masterminds, the educational masterminds, growing, scaling those, because those can be billion-dollar businesses. And then the e-commerce stuff that makes up 90%, pretty close to 90% of our fund. Beyond that, it's just the occasional Broadway or theatrical production that comes
Yeah,
along, which is a very, very small percentage of what we're doing. So outside of that, no, I'm not looking to go any wider or diversify beyond the e-commerce and the mastermind businesses that we're part of.
focus on, yeah.
Yeah, yeah.
Rich, thank you as well for joining there. We appreciate you coming on as well. Ray, before ending the meeting, would you kindly briefly recap the 5 highlighted benefits of the 5 profit centers? Yeah, we can do that right now. It's pretty straightforward. Number 1 is cash flow. Number two is appreciation. Number three is equity accrual. Number four is depreciation or tax benefits. And number five, in Marco's case, he likes to call it a fifth one, is leverage, using the bank's money. And if you go to
Yep.
Google or you go anywhere else and you type in five profit centers of real estate, you'll get the same answer, most likely. So you can find those benefits for sure.
And you'll probably end up finding our article online as part of our
Probably,
blog.
probably our podcast.
Right. Yeah,
Uh,
exactly. You want to take another one or two?
Yeah, Tom, so you're using the note capital to what with? I apologize if we haven't been clear on what we're using the raised capital for. We're using the raised capital to grow and expand the businesses that we currently own, right? And Marco's mentioned several times, we're growing the e-commerce space and we're growing the live event space, the mastermind education space. So that capital goes to specifically to grow those companies. Do you want to elaborate on that anymore, Marco?
No, you pretty much summarized it. We're just going to continue to grow and scale our existing investments and business ventures so they
Right.
become more valuable and more profitable.
Yep. So good question there, Tom. That's a good
One
question
more?
for you there, Marco. The one that Jack asked, since COVID was a Black Swan event, did that impact the promissory note fund?
Jack, that's a good question.
Yep.
Yes and no. No, it did not affect or impact our investors. They still receive their distributions each and every month. That doesn't change. It didn't change and wouldn't have changed. But it did have an effect in the background because on the in fact, it actually had a positive effect on the e-com side. People were actually forced during COVID to shop online. You know, retail stores and whatnot were closed, and a lot of people didn't want to actually leave the house to go and shop. In person. You know, this is where the whole thing came up with retailers having curbside pickup and all that stuff. This was
Yeah.
all born out of COVID. But COVID helped us in two ways. One, it exploded the number of people shopping online, and number two, it actually helped us in our deal making and acquisitions for our ecom businesses because it just somehow forced retailers to become financially troubled or insolvent because people weren't shopping at the stores. They still had to pay the lease and the utilities, the lights, electricity, whatever else, their staff. But they had no foot traffic. They had no people shopping at the stores. So it actually made it worse for them, which made it an opportunity for us. So it can work both ways. It's kind of like a double-edged sword.
Yeah.
All right. So all kinds of more questions came in. I mean, we can go for a few more minutes if you want. I don't want to keep
Yeah,
everything
we have a
on.
few more left here. Teresa, I'm happy to talk to you offline about, getting into properties and real estate. The fact of the matter is there's a long answer to that question if you're looking to get into real estate with none of your own money. There's coaching programs dedicated specifically to that kind of thing. But so let's go ahead and reach out to me offline. I would go to naradacapital.com and put your name in the investment section, and you should get reached out to one of our assistants that can schedule a call. So um, we'll start there. Charlie asks, have you heard of a first spot with HELOC mortgage? I'm not sure what you're referring to, Charlie.
Yeah,
Do you
what he's referring to is a HELOC mortgage in first lien position.
first
And
lien
yeah,
position? That's what it's, yeah.
yeah. I don't remember the lender. There was at least one lender that I've seen that would give you a HELOC type of mortgage and put that in first lien position. So you would have your mortgage loan, but it was also a home equity line of credit. You could add to it. You basically had access to that loan as a line of credit.
Yeah.
Um, I don't know the lender's name, but I remember the lady, the loan officer or mortgage broker that pitched it to me, and it might still be available today. Um, if it's something you're interested in, just contact us, and I'll put you in touch with the lady that I was working with. So, Jesse, yes, IDEAL is an acronym for income,
Yep.
depreciation, equity growth, appreciation, and leverage. I like how you added one more I to it, inflation hedge. So it's ideal. That's good. I like
Good to
that.
see you on here, Jesse, by the way. We've worked together before, so thanks for
Yeah,
joining, man.
yeah, very cool. Let's do one more. Um, Michael down there. Historically, how has the percent return varied over the years? I ask because I get first note of 200,000, 15% for 7 years, and another for 200,000, 15% for 3 years. What is the likelihood that in in 3 years I can reinvest the 200,000 for another 15,000? Okay, Michael, good question. I don't know if you're saying you are already an investor client and you're invested and those are the two notes you have, or this is a hypothetical example. But in either case, if you have two separate notes of 200,000, they're both going to earn 15% per year, regardless of the terms. That first one being 7 years, the second one 3 years. If your 3 year note matures, okay, it's a hypothetical. If the 3 year note matures and this offering is still on the table, you're welcome to reinvest. I
Yeah,
don't foresee the terms changing. What I can't guarantee is with a 3 year time horizon, if this offer will still be available 3 years from now. This is why we have the longer terms, so investors can lock into that 4, 5, or 6 or 7 year note term, so they are locked in and getting that rate of return for a longer period of time. And this is especially good for those who have self-directed retirement accounts like an IRA, a 401k, or a Roth account. So you can continue to get that higher yield, that predictable monthly income in your retirement account for a longer period of time. And so, so if you're looking for a longer term and lock-in period or investment, do a 4 or 5 year note instead of the three. I'm not telling you what to do. I'm just, food for thought. So, but if it's still available in 3 years, great. What I will say is this: we're probably going to start to wind down this offering in about 24 months. I don't have an exact time frame, but we're reaching a tipping point this year where revenues will start to accelerate and our need to raise capital will diminish. So after 12 months from now, or even 18 months from now, things will start to reverse. We're going to probably raise less capital, pay off more and more notes,
yeah,
and just change the balance sheet to be even more interesting. So, Michael, I hope that helps. If it doesn't, just talk to Nate or whoever your investment counselor is about it.
perfect. Well, I know we're a few minutes over here, Marco, guys. If you have any other questions, feel free to reach out to us. And you can contact us either directly to me or Michael or John if you have their direct information. If not, through Jessica or Liz. You can also go directly to neuroticapital.com and put in your information there. There's a chat box you can use. Yeah, and we can go from there. Does that work for you, Marco?
That sounds perfect.
All right, sir.
Well,
Um,
thank you, everybody.
thank you for joining us, guys. We will be on here again next week and we'll keep the ball moving forward, okay?
Sounds good. Thanks,
All right.
everyone.
Take care. Bye-bye.
Take care.